Okay, all right. Then we have the term internal and external fund. What does it mean by internal fund? Okay, here I assume when you have started the business, okay, when you have started the business, then you may have quite a number of options for you to finance, to generate funds internally. Okay, let's say for example, through profit. When we gain profit, you may decide on how many percent should you retain for the business operation for the next year. Okay, or you may decide on how many percent can be used as capital or running capital for the business. So then we have the sale of asset or little use asset. What does it mean by this? This is actually you may decide on selling the asset, for example, like a machine, for example, the old machine that is rarely be used by the business. So you just sell it and get the money as the source of funds for the company. Working capital reduction is actually involve the account receivable, involve also the uh, suppliers. Okay, okay, what does it mean by all the working capital? Working capital is if you have the working capital is actually the difference between current asset and current liability. So it's better for you to have more current asset than current liability. But in some situation, it depends. For example, like okay, we take this one, extended payment terms from supplier. Okay, when you need more cash for the company, okay, so you may try to extend, instead of paying a supplier, you better keep cash for the company, for example. Okay, reducing a short-term asset, like for example in inventories. So you try to decrease the amount of inventories in your company, which is actually quite good in some situation, but not for cash. Okay, not for cash. You have to try hard to maintain, or to at least maintain or try to increase your cash as much as possible. Okay, you better avoid to spend more a lot of cash for the company. Okay, even though if it is a big company, they need cash, more cash for the company, because uh, yeah, that's another what we call that if you are the finance manager or accounts manager, you will know in detail on that why we need cash, uh, strong cash for the company. So even if it's a small business, you still have to try try your best to maintain, at least maintain your cash instead of spend it all. Okay, this is related to internal funds and the external funds. Criteria for evaluating external funds. We have the length of time the funds are available, cost involved, amount of company control loss. Okay, external fund can be from the debt financing or equity financing. Debt financing, for example, like you pinjam the bank loan. Okay, the bank loan. So you will look at the interest rate. You will look at the length of time the funds are available, maybe 10 years, the short term 5 years, for example. The cost involved, tengoklah, is there any hidden costs and whatsoever. Okay, what does it mean by control loss? Control loss if it involve equity financing. Control loss, control in terms of the ownership for the company, of the company. Okay, maksudnya previously we are the only owner for the company. Okay, and then when you finance using equity financing, you may have to uh, give up, okay, some percentage of the ownership. Okay, personal funds. These are the types of finance or funds. Okay, what does it mean by personal funds? I believe you know about this. Personal fund maksudnya our personal money. Regardless lah whether it is you save it in the bank or you save it at home, as uh, as long as it's savings. Personal funds can be, for example, you want to start a business, you don't have money, even the cash you start the savings, you don't have it, and you may decide to sell your car, for example. So that is, or you may decide to mortgage your house, uh, and use that money as a source of capital for you to start a business. So it's up to you. So it can be anything as long as it is related to yours. Then we categorize it under personal funds. Most of the small business owners or entrepreneurs, they they this is the best option for them. Okay, because it is least expensive funds, and it will not involve any ownership, loss of ownership. Okay. Okay. Funds from family and friends likely to invest due to relationship. Yes, of course. You have advantage and disadvantages of using it. Okay, like look at disadvantage: direct input into operation of venture. So another one is in terms of relationship with their family and friends. If something happens to the company, so you have to bear in mind all those consequences. Okay, and then we have the debt and equity financing. What does it mean by debt financing? You borrow money from the bank, for example, for the company. Asset-based financing requires some assets to be used as collateral. For example, some financing they may need collateral or security for them. Maksudnya you have to use your house as a collateral for you to get a loan from the bank, for example. Okay, borrowed funds plus interest need to be paid back. Yes. So this is the commitment that you have to bear if you go for debt financing. Maksudnya, of course, like when you borrow, you have to pay it back, but not pay only the debt, but you have to pay the debt together with the interest. Okay. Equity financing. Okay, equity financing, you get a fund for the company in exchange for ownership. It means that instead of own the company 100% by yourself, but this time you have to share with the equity finance those who provide you equity financing. So does not in the beauty of this, it does not involve any collateral. No need for you to provide any security for this, because you have to let go the ownership, and no need for you to pay it back. Okay, it's different from, that's why some entrepreneurs they prefer equity financing instead of debt financing. Equity financing, no need for them to pay it back. It just they but instead they have to let go of some percentage of their ownership. Okay, debt financing again. What are the advantages of debt financing? We look at here, you have the bank or lending institutions has no say in the way you run the business. They do not have any control of your the way you are running your business. Okay, because they bagi pinjam, they just lend you the money, then you have to pay them back. So nothing to do with they cannot control you lah, to run the business. And you have to pay them principal, the debt itself, as plus the interest. The loan can be short term and long term. I mentioned just now. The interest on loan is tax deductible. You have to know, bear in mind that when you want to pay the tax at the end of the year, then for that every year you have to bear in mind that interest on loan is tax deductible for the company. The business relationship ends once the money is paid back. So if our term for the loan is 10 years, so after 10 years, nothing to do with the bank anymore. Okay. And what are the disadvantages? There are several disadvantages. You can read on this. let us discuss some of it. Let's say, for example, if you rely too much on debt and have cash flow problems, you will have trouble paying the loan back. So yes, of course lah. This is normal actually. Let's say assets of the business can be held as collateral to the leader, and the owner of the company required to personally guarantee the payment of the loan. This is the advantages. Okay, because some banks they need the collateral, they need security from you. So maybe you mortgage, use your house as collateral. So it's quite risky in case something happened to to your company. For example, bankruptcy, for example. So you have to the bank will take your house because your house you use it as a collateral. So the bank will take your house in exchange of for the loan that you borrowed from the bank. So quite risky. Okay. Others you can read by yourself, and I believe it is easy for you to understand it. Okay, and we have equity financing. What are they? Equity financing, this type of financing can come from your personal savings, families and friends, as well as the partners. Okay, equity financing when it involves ownership. Personal savings, yeah, of course, ownership, it involves ownership. If it is involve external party, these investors or partners, okay? If it involves external party, we call it as partners. That's why when we as partners means that you have to let go some of the ownership. Okay, equity financing involving investor or partners who provide capital in exchange of for a share of ownership of the business. All right, and then no battery. All right, sorry, yeah. Okay, so this is the advantages. We want to discuss about the advantages of equity financing. Actually, I should put as advantages. Okay, the beauty of equity financing, as I mentioned earlier, it is no need for us to pay it back. Okay, no need for us to pay it back because since they will be our partner, so the their money will be our money as well for the agreed percentage. Let's say we agree to let go of 20% of the ownership of the company. For then the investor for equity financing they have to invest 500,000 in exchange of 20% of the ownership, for example. And another advantage is that since we have the partner and the partner, the investor is most of them, okay, like for example, business angel, they are the successful entrepreneur in other businesses, and their networking, of course, is they have a very good networking, so we can make use of those networking to run our business. Okay, and then what else? Other thing you can read by yourself. I believe, let's say this one you will have more cash. Yes, of course, lah, because just now I mentioned like we exchange 500,000 for 20%, for example. So 500,000 is our additional cash, even yeah, in exchange of 20% of the ownership. Then it is less risky. Why it is so? Because yeah, it's different from debt financing. Like for example, debt financing you have to pay back, and you have to some of it you have to secure with something as collateral. But for this one, for equity financing, no need. You can get your cash. You just shout out there. The only way the only way is that you just have to let go of the ownership. That's it. All right, this is the disadvantages. Okay, so disadvantages of equity financing. Just now we mentioned it, for advantages, you can have partners with extra cash, okay, partners with extra cash. But you should bear in mind that when you get a partner, it means that whatever decision that you might want to make for your business, you have to discuss with your partner. Okay, just like when we live single and then we got married. Okay, so before this, you whatever that you want to make, decision that you want to make, you just decide by yourself. But when you have partner, of course you have to discuss it. So it's same goes to the equity financing. So you have to discuss whatever decision that you want to make, you have to discuss with the partner, which is the investor from the equity financing. Okay, that is the one of disadvantage. And of course, another one is the in terms of the percentage of the ownership. Okay, what else? And okay, if you have any disagreement with investor, so you may need to cash in your portion. So let's say investor doesn't agree with your decision, so but you still want to proceed with that decision. So you cannot use investors' money to do that, to proceed with whatever the plan. So you still have to use your own money, even though you have let go the ownership and so on. So there are quite a number of disadvantages of using equity financing. So that means that before you decide on which financing that with which financing that you should involve in, you have to bear in mind of advantages and disadvantages, especially the disadvantages of that particular financing. Okay.